Hi, everyone. Today we're going to be talking about crypto scams, fraud, crashes, hacks, and how that relates to the current situation that we're seeing ourselves in. So let's get started because I know everyone's probably keen to head off early and enjoy their long weekend. Hi, Ioannis. How are things?
Hi, Joshua. Things are fine. Interesting topic today. Very much look forward to the discussion.
Indeed. So, Ioannis, when we talk about scams, fraud, what was one of the most recent ones that sort of really got this discussion going?
I think 2022 has been a very bad year for crypto overall, right? It was a year of way too much turbulence. We don't hear about too many events nowadays. At least they don't make headlines. But the past few months, especially those of 2022, have been full of such events. But I think just what there are two that really stand out because of the magnitude of failure and the symbolism that they have been carrying with them. And the two that I have in mind, the one is the Terra Luna, the collapse of the algorithmic stablecoin. And apparently the other one has to be FTX because it has been one of the most infamous, so to speak, players into the exchange market.
That's right. So Terra Luna was a stable coin. It was this mix of a coin that was used for certain activities of this ecosystem, along with a stable coin. What is a stable coin, Ioannis?
Well, I'll take a risk with that.
Yeah.
although I'm partially in a good position because at least the very latest draft of MICA is now out, so I can give a definition that it also complies with what will soon be the law in the European Union. And if I understand it correct, a stablecoin is of course a crypto asset, but it's a crypto asset that is primarily thought to be used as a means of exchange, right? It's a form of digital money, so to speak. The interesting thing about stablecoin and where it derives its money from, which is a good marketing, by the way, is that it always, as a product, applies a mechanism that it allows its price to remain relatively stable, which is a basic precondition for something to function as money. Stablecoins, so to speak, were an idea in the crypto space, which was invented when everybody realized that cryptocurrencies per se, they are not suitable to be used as money because of their so-called price volatility. They have a tendency to go up and down in an uncontrollable manner for transactions to be relatively trustworthy, so to speak. So with stablecoins, the idea is that there is, of course, a crypto asset, but the value of this crypto asset depends on an underlying asset. This crypto asset, this stablecoin, is always pegged, as we use the term, to another asset. That can be anything, by the way. That can be something that exists in the real world. For example, it can be gold, or it can even be what we call fiat currencies like euros or dollars, right? Or it can even be crypto assets like Bitcoin itself, right? Provided that it can support, so to speak, the value of the currency. Ideally, the idea is to keep an one-on-one peg. For example, if we think of Tether, which is a very famous stable coin, they say one Tether, if you have in your hands one Tether, that equals to $1. That practically means that you can give $1 and receive one Tether. You can use Tether to do your transactions, and at any time, if you still happen to hold Tether in your hand, you can return it and receive your dollars back. That's the basic idea, so to speak.
That's right. So they should have an amount, let's say Tether, for example, they should have an amount of dollars somewhere, and different companies who back stable coins might have different assets which have backing up to that value that they should have. So I should be able to go to the company and reclaim my dollars from them, right?
At any point without any restriction. Ideally speaking, companies that issue stable coins, by the way, the law doesn't call them, unfortunately, like that. It uses complicated terms like asset reference tokens and e-money tokens. We might explain that at some point. But indeed, the idea is that you can at any time redeem it. Redeem means that you can at any time return it and receive your money back, so to speak, your dollars or euros or Bitcoin, if you use Bitcoin, if the system uses Bitcoin to stabilize its price. And that is essential, by the way. That is what allows people to have trust to the stablecoin. And also it is essential because in reality, for a stablecoin to be successful, the company behind it must be at any point to redeem the entire supply without any losses, because then of course things will become complicated. In an ideal world, of course, we all know that, or nobody is certain that the stable coins that are out there literally have assets that can 100% back the stable coins that they have issued by now, right?
Indeed. I mean, even if we look at currency, right? If we look at the dollar, at some point it was backed by gold. And it's the same thing. $1 is stable. There's an amount of gold that I can go and claim back. Yes. And we trust that, let's say this is the system that we're working with. We trust if we all go back at the very same time to this place with our dollars, we can get back an amount of gold. Yes. The same thing now exists in these stablecoin companies, that we are trusting these companies to offer the service. What happens if we go back and we they don't have the stocks? What happens then?
I think it is a classic case of a bank run, as we call it in the slang that we use sometimes in some of our everyday transactions. That means that people will try to all automatically ask for their assets to be returned. If the company happens to have them, it's okay. But the value of the stablecoin, of course, it will take a strong hit. But in many cases, they don't. Which means that there are people, let's say, for example, that I gave 2 Bitcoin in order to buy a certain amount of stable coins, right? If I return the stable coins, the equivalent value of stable coins, and the company doesn't have enough Bitcoin, that means that I will never get my Bitcoin back. It means that I lost 2 Bitcoin, so to speak, right?
That's right. So, okay, so this hasn't happened yet, though. I mean, in the crypto space, there's been a lot of talk in regards to whether we can trust particular stable coins who have backing, who like Tether, like, do they really have the dollars? Do they really have the assets? However, coming back to Terra Luna, an algorithmic stable coin, how is that different to these types of stable coins?
Yes. Before we go to that, in order to talk about Terra Luna, I think just why it is important to watch at least 1 minute from a video that Terra Luna has prepared when they first started their operations, because they kind of explain a little bit the basic mechanism. Of course, we will explain though why it went wrong. But another important risk with stablecoins is that we do not only trust that they will have enough to return to us, but we also trust them with having custody over our assets. If I give, for example, if I give dollars in order to buy Tether, right? That means that my dollars right now rest with Tether. Tether has control over them. And of course, Tether can do anything with it, right? I will not know. They might, for example, invest it in products that are not good enough and they might lose it. Or they might loan it to somebody without me knowing, and then they might be unable to return it. So this is a second issue, a second trust risk that is involved there. It's not only that whether we're going to have the money or not, but what they're going to do with our assets during the time that we trust them with these assets. Having said that, let us see the case of Terra Luna, which is the first major event that we had last year. And let us watch just a minute of their video, just a basic explanation of what they had in mind as an idea. I think I'll have to share my screen for a second.
Yep.
So let me do that.
Also press share sound at the bottom.
Sorry?
When you share screen, also press share sound.
Yep. Just so I will need those sharing rights. I don't think I have them.
Okay, so 1 second. You should be able to.
Okay, now I can. Yes, excellent. Excellent. So let me go here. Yes. And my sound. Excellent. So I hope you can see the screen. And let us have a first look.
How does Terra work? This is 1 Terra US dollar, or UST for short. It's a currency built on Terra's blockchain. The price of 1 UST is determined by how many people want it, and by how much UST is available. Let's imagine the entire Terra economy as a pool. The size of the pool is determined by the total supply of UST. If more people want UST, the tide rises, and if less people want UST, the tide falls. The height of the pool represents the value of each UST. If you can do more with UST, like buy coffee or invest in stocks, more people will want to buy UST, driving up its price. To bring back the water level to $1, we can expand the pool by introducing a new supply of UST. But where does new UST come from? At Terra, we've designed a machine that swaps $1 worth of Luna to 1 UST. Investors who predict UST will be more useful and used in the future can buy and hold Luna. When the value of UST rises above $1, any Luna holder can swap $1 worth of Luna for 1 UST and sell each UST for more than $1, making a profit. The newly introduced UST expands the pool, bringing its price back to the $1 peg. Now Luna is more scarce and therefore more valuable. During times of contraction, any UST holder can profit by swapping UST for Luna, raising the price of 1 UST back to $1 US. As UST becomes more useful in the long run, Luna...
I think that was indicative of what was the basic idea behind it. In essence, with algorithmic stable coins, I mean, first and foremost, that is a particularity, or not a particularity, but an important point on the Terra Luna saga, is that Terra Luna wanted to be fully decentralized and fully outside of the real economy, so to speak, right? It didn't want to peg its value to any real economy assets, either fiat money or even gold, right? This is why it created a parallel crypto asset that was Luna. So the USDT was the stable coin that was used for payments in the market, and Luna was supposed to be the parallel crypto asset that was supposed to be helping keeping the $1 value of the USDTs. And it all, of course, ran on smart contracts and the such. When in the video they say we built a machine that prints USDTs by using Luna or burning USDTs to return it to Luna and such. In essence, that was a smart contract arrangement that allowed these things to happen automatically. So in a way, the parallel crypto asset, which is Luna, was supposed to function as some kind of gold or any other underlying asset that was supposed to be keeping the value of USDT at $1 at all times. So far so good, right? So far so good.
Yeah, that's great. But how does this Luna become like gold and get this value?
Exactly. The fatal flaw of such a system is that there is zero guarantee that Luna is going to worth something.
That's right.
Right? Of course, you create a parallel asset and you peg your value to that asset. But what guarantees you that this asset that you created has value? We know, for example, that gold has value for thousands of years because of certain inherent characteristics, right? But with Luna, that was not really the case. So it means that at some point, the system would collapse on itself, so to speak. And of course, there is a trick here, and I think that's what the Terra Luna team tried to do. Luna and USDT could obtain lots of value if they would be popular enough, if they would scale to such an extent that as a product of payment on itself, they would acquire much value. This is why in the initial stages of Terra Luna, Doc Won and one of his co-founders, who also founded another company which is called CHAI, C-H-A-I Payments in South Korea. This was a company that was offering e-commerce payments. And one of the biggest selling points of Terra Luna was, well, why does USDT has value? But because it is the digital currency of e-commerce. Because eventually everybody on e-commerce is going to use USDT. And therefore, there you have it. The Terra Luna ecosystem will always have value. Which, by the way, it was like taking a major bet or making a huge gamble. I believe that also explains why Doc Won, during the entire lifespan of the project, was making all kinds of pompous claims around social media, because such instruments need that kind of pumping, so to speak, so that more investors are drawn in. In fact, it has been proven that Tsai at some point stopped using USDT. They stopped cooperating, but Do Kwon did not disclose that. That's one of the things that will come to bear now that he's arrested and he will be further investigated. But
Indeed.
the truth is that, I mean, don't get me wrong, Terra Luna grew and grew fast. It became overnight one of the most popular assets, but
Right.
it just didn't grow enough in order to defend itself from possible attacks or any other incidents. And one of the things that is interesting about the Terra Luna debacle is also the following. If somebody watches that video till the end, the whole idea behind Terra Luna was that it doesn't need a reserve asset or any reserves, because it obtains its value from Luna. But when Do Kwon started feeling that clouds are gathering, he created an emergency liquidity pool, which of course started raising questions. Why do you need that if you claim to have an asset that is always going to produce value for itself?
Indeed.
So, you know, there were cracks here and there. And of course, another parameter in the whole Terra Luna environment is that in order to make Terra Luna and the ecosystem attractive, Do Kwon kind of founded some kind of a bank that was called Anchor. And Anchor was promising 20% yield for deposits. 20% yield, though, is not sustainable in the long term, right? You can do that for a period of time in order to be able to attract customers. But Do Kwon was adamant that he can forever offer 20% yield on deposits, which, of course, kind of gave him some kind of liquidity from all the people that went there for the juicy yields. But the system, but eventually he would have to pay the 20%, right?
Indeed. So I'm not saying that's impossible, but every single advertising I've seen or promise of, and it seems like a magic number, this 20% APR, every single one has eventually come down. I'm not saying it's not possible, just raise some alarm bells and look into it if you're being promised 20%.
Indeed, people need to be warned that if somebody promises them 20% yield, I mean, let me tell you, that is, I think, 200 times more than normal banks, which is already high. It's already alarming. And that is more than twice than what other crypto banks are offering. So,
That's
you know,
right.
and that is not a coincidence, by the way. There was another minor crypto asset that collapsed a couple of weeks after Terra Luna. They were offering 17% yield. So, you know, everything that hovers around 20 is usually
Look into it.
right?
Indeed. Okay, so we have stable coins which are pegged to $1, and we would hope that the dollar is always there, claimable. We have algorithmic stable coins that are pegged to some way of reaching stability, like Terra Luna, and we hope that they can somehow guarantee that value, which we've seen Terra Luna can't. Great. Okay, so that's one lesson that we can learn. But moving forward, is everything rosy after that collapse? Have we learned our lessons?
Well, probably not, because in reality, the debacle of Terra Luna was just the beginning, right? I think, I mean, first and foremost, we need to remember that the Terra Luna collapse sent the crypto markets in disarray. I think Bitcoin lost huge value only days after that incident. And that already shows, by the way, how big Terra Luna became at some point. So Do Kwon partially achieved expansion, right? But it also, you know, kind of revealed that now the crypto market, of course, is interconnected, which is barely a surprise. In fact, what Terra Luna did, I believe personally, is that it really triggered or hastened the collapse of FTX. I think that the fact that FTX collapsed a couple of months after the Terra Luna debacle is far from a coincidence, so to speak.
Okay. And
so if I remember it correct, at some point in 2021, Bitcoin was trading at around 60,000.
that's right.
When we entered 2022, it was still going strong. It was not 60,000, but it was near it. After the Terra Luna debacle, it went, you know, 50, almost 50% down.
Yep.
which is down to 30. And then if you remember, the summer was also particularly bad. I mean, Bitcoin kept going down all the way through the summer.
That's
and then,
right.
of course, FTX happened, and FTX brought it even lower. I mean,
Okay.
I remember that in October, November, Bitcoin reached 15,000, which is miles away from its highest point.
And what is FTX? What is this whole crash that happened? Can you explain it a bit? I'll draw it as you're explaining.
Yes, I will. I'll try. I'll try to the best of my capacity, so to speak. Right. So to talk about FTX, first and foremost, we need to remember that this is not the only entity, right? There is a person behind that, which is Sam Bankman-Fried, right? The infamous owner. And before founding FTX, which was a crypto exchange, Sam Bankman-Fried has created a crypto hedge fund, which was called Alameda, or Alameda Research, as it was the name. And in essence, what Alameda did, I mean, Alameda was founded in 2017. And I say it is a crypto hedge fund because what Alameda did was that it was trading in crypto assets. It was doing crypto arbitrage. Crypto arbitrage is a marketing strategy by virtue of which you buy crypto in a market where crypto is sold at a relatively low price, and then you sell it at another market where crypto is higher, and then you profit from the difference. So that's what Alameda was doing, right? And by the way, Alameda was relatively successful. Sam Bankman-Fried in 2017 was able to quickly make 20 million, which, by the way, if he was not greedy and he had stopped and retired there, he would have led a nice and peaceful life, right? But he didn't want to stop there. Of course, he wanted to do more. So in 2019, he founded FTX, which was a crypto exchange. So, it was a platform where people could give fiat assets and then start trading on crypto assets, right? That was the two entities, FTX and Alameda. As it has been proven, I mean, for the entire period before the collapse, people were speculating, okay, we have the same person that seems to be behind the companies. What is the relationship between the two? Are they completely independent and such? Well, truth is that that nominally, Sam Bankman-Fried left Alameda in the sense that he was not the CEO anymore, and he moved completely to FTX, right? This is the point where he leaves Alameda with Caroline Ellison, which is another important person in this story. And in fact, in many of their public statements, both Sam Bankman-Fried and Caroline Ellison insisted that FTX and Alameda are completely separate entities, and that in reality, Alameda is just another FTX customer. Because of course, Alameda was using the services of FTX to do crypto trades, to carry on doing crypto arbitrage and other investments in the crypto space. Of course, if one reads through though the lawsuit of the SEC, these entities were all but separate, right?
Indeed.
And it's not because they were controlled by, it's only because they were controlled by the same person. But it was also because Alameda was not a typical FTX customer. It was an FTX customer that had a virtually unlimited line of credit. In reality, that means that Sam Bankman-Fried was using customer funds from FTX and was putting them in Alameda. So Alameda's trading activities and all other activities were funded by FTX customer funds. Right?
Yep.
And of course, Alameda also had several privileges when it came to using the platform of FTX. But I think the most important that explained the collapse is the fact that Alameda had an open line of credit from FTX. That literally means that whenever Alameda needed money, Sam Bankman-Fried will take that money from his FTX customers and will put it in Alameda. Practically speaking, people were trusting Sam Bankman-Fried with their money in order to do crypto transactions, believing that they are still in control of their underlying assets, while their underlying assets were used by FTX in order to fund Alameda's trading activities. And then you might ask me, Ioannis, it has been proved that this was the case since 2019, the date that FTX was founded. How it comes and they did not collapse earlier?
Yeah.
I mean, is Caroline Ellison some kind of trading genius that she was able to always play with the customers' money and always make more, so they would always have money? The reality is not. What FTX and Alameda were capitalizing on was the high crypto prices. Because remember, 2020, 21, and early 22, crypto was going higher and higher, which means that you couldn't go wrong. And no matter how bad your trades might have been, you would still be able to win. Therefore, you would not have an apparent liquidity crisis at any given, in any obvious manner. This is why I said earlier that I believe that the Terra Luna debacle, in a way, started unraveling the FTX tragedy. Because after Terra Luna, the price of crypto assets went low, which means that all the risky activities of Alameda stopped paying off. That means that Caroline Ellison was betting and losing FTX customer money at a rate that they could not replenish anymore.
So looking at this, let's now consider that FTX and Alameda, just for a second, that it's a single entity. It means that all the customer funds that were circulated into this entity, they're still there, right? They're being played around within the single entity. When you say they had an unlimited credit, how did they establish unlimited credit? Because they're limited to the inflows of funds, or did they have access to something else?
Yes, indeed. But look, FTX was keep growing its customer base, which means that whatever new customers were coming, the funds would be then channeled to Alameda one way or the other.
I think they also had this FTT token, right?
And then that comes also, of course, that is also part of the game, that FTX had its own asset, right? The FTT token, which allowed the users of the FTX platform to do all kinds of transactions and obtain all kinds of privileges by buying this particular token. Now, after the collapse, it has become obvious that, in essence, Alameda was using FTT as a collateral in order to take loans and the such.
Indeed.
In essence, let me put it very bluntly, Joshua. Let's say that I come to you and I ask for a loan, right? What are you going to ask me? A collateral, isn't that so? You're going to ask me to put a mortgage on my house, to give you my car, I don't know, right? Well, what Alameda did is that instead of doing that, they were giving FTT as collateral in order to be able to take loans. Now, there are several problems here. First and foremost, who makes sure that FTT has any value that corresponds to the loan that you have obtained? And secondly, isn't it a very convenient arrangement? Because in reality, what Alameda said is that, yeah, you need collateral. Okay, let me print you some collateral. What a fantastic world would that be if we could simply go to a bank, the bank asks for a collateral, and we say, yeah, look, I have this nice pen, I have this nice notebook, or I have these sheets of paper which you can use as collateral. They worth as much as your loan, don't worry.
And indeed, but from the perspective of the bank, Alameda saying, can we please have money, whatever. And they're saying, okay, but what do you have? And they're saying, we're getting FTT. They go to themselves, but from the bank perspective, it's a different entity. And they say, oh, you have these new tokens that are worth, I don't know, $1 million, whatever. And the bank looks at them, they're worth $1 million, but they were just created out of thin air.
Completely out of thin air, by the way, right? Completely out of thin air. And by the way, there is another interesting part in this story. Do you know who was one of the very early investors on FTX? Very early investors. A person named CG, a person that happens to have a competitive exchange, which is Binance, right? CG was one of the early investors. In fact, CG bought 100 million worth of FTX in all kinds of forms. Part of it FTT, it was shares. And Sam Bankman-Fried paid him $2 billion to take the shares back, so that to have control. What did CG take in return? FTTs. When Sam Bankman-Fried, tried to reclaim the shares bought by CG, he also gave him FTTs. Why do I mention that? Because that also contributed to the collapse of FTX when things started going south. We all know, for example, that it all started in the beginning of November 2022, when certain news portals were reporting that something must be wrong with FTX. There were rumors for customer funds mismanagement, and of course rumors about the relationship with Alameda. And immediately what CG does is he sells his FTT, which throws now the value down. Look now, right? We said that Alameda was using FTTs as a collateral in order to take loans, which means that the ability of Alameda to pay back these loans now heavily depends on the value of FTTs.
That's
so
right.
Single-handedly, by offloading, I think 500 million worth of FTTs, CG has almost in a single move decimated the value of FTT tokens, because then, of course, everybody else started trying to sell, right?
That's right. So looking at this scenario, what lessons can we learn? I guess from a bank perspective, from anyone investing in these companies, you really need to have full visibility of all the entities that they're involved with, right? All the counterparty risk. So banks should not be asking for FTTs and to see their balance sheet, but they should be asking for also clarity on where that comes from and who's involved. I think that's one important lesson. Another important lesson is when you have the ability to print some assets on demand, we have to see how that can affect the value of the asset. And also when an individual has so much assets in his control, dumping those assets can also bring down that value. What is the ramifications of that? Okay, so do you think the story ends here?
I think there is some before we go forward, though. There is a small other detail which I think is important, and that is what else we know about FTX is how important it is that crypto exchanges have robust arrangements as regards customer fund management. What happened with FTX is not really a novelty, by the way. A couple of years earlier, the same thing happened with Quadriga CX. It happened in Canada, of course, not in the United States, but it was exactly the same problem. The problem that customer assets were used for speculative trading by the exchange platform, which is something that, must not be allowed, simply put. And by the way, this is where the upcoming MiCA regulation might be of help, because MiCA prevents that from happening. Okay, I'm not saying that there is no way to go around it, but it puts a more robust framework from that, right? In fact, crypto exchanges after MiCA will have to adopt a customer fund management policy, which they will have to make public. And also they need to enter contractual arrangements with the customer that ties them to certain customer fund custody rules, that they cannot simply, let me put it in these words. Before MiCA, FTX and Binance can tell you, we take good care of your funds, don't worry. Well, now that is not enough, right? There are extra requirements that need to be met. And as I said, they need to have a customer fund custody policy, and of course they need to enter binding arrangements with the customers. And in fact, they need to take measures so that they can prove at any point that they do not manipulate customer funds. So that is important. That is very important. But I agree with you that at the end of the day, people that invest must always be mindful, where does this company get their assets from? Why do they have value? Where does that value come from? And if the answer is, well, we print our own assets, then people must, think twice.
That's right. But a solution to this problem is regulation, putting in place certain procedures that exchanges and entities need to follow, and a regulator that is making sure that these processes are in place. And that should solve the problem, or solve the problem to a certain extent. Okay,
or at least
great.
Give us hope that we're going to do a little bit better, that we're not going to have such spectacular problems. Are we going to still have problems? Of course. As I said, regulation is there. People will always try to find a way to go around it one way or the other. But again, it will become tighter nonetheless, and that comes with its own value, that it will be tighter.
So the markets in crypto assets regulation, MiCA, is supposed to help resolve this. Now, this means the markets are going to get a bit tighter. There's going to be a bit more burden. What is the trade-off then of this?
Well, the apparent trade-off, first and foremost, is that small startups probably will have a problem entering the market. You're not going to see as many exchanges or as many crypto assets anymore, because simply put, they will not be able to bear the cost of compliance, which means that this will allow big players like Binance to consolidate their position. In fact, Binance will probably go unopposed now. I think they are by far the biggest player, and they can't bear the cost of compliance. So that will for sure make the market, let's say, less open. Now that has pros and cons, right? Pro might be that dubious projects will not appear on the horizon anymore. It is a deterrent for all kinds of dubious projects. But at the same time, it comes with the con, for example, that the market might be dominated by Binance. So then we will create another problem. We might create an exchange that is too big to fail now, as we usually do in other parts of the economy.
That's right.
And we have heard that before, like banks are too big to fail, right?
And let's come to that in a second. One point I'd like to highlight is in this scenario here, we have an opaque system. We cannot see what's going on, what assets they have. And interestingly, in the space, solutions were proposed to help get around this opaqueness by making it more transparent. So coming up with proof of reserves where your assets would be listed on a blockchain and everyone can see the assets that you own. Now, I'm not saying that's a perfect solution, but it's interesting to see how the technology itself, so what they're trying to sell, crypto, can provide a solution to this very problem that they've introduced into the crypto space. Okay, excellent. Now, coming back to banks. So what, a month ago, 2 months ago, I can't remember when, SVB, I think, was the first thing that we heard in the news. Silicon Valley is going down. What happened there?
Which, by the way, a funny name for a bank, right? Silicon Valley Bank. Although the name was not a coincidence, by the way. It was indeed the bank at Silicon Valley that was loaning money to tech startups, right? Which, by the way, might be a very profitable business model. I mean, Silicon Valley is the capital of tech innovation in the world, right? Having a bank that loans money to such institutions can indeed be lucrative. You might have given loans to the next Apple or Tesla or ChatGPT or whatever. And well, while this sounds, you know, interesting and well, the thing is that for a bank to be able to give loans and be able to operate, so to speak, they need deposits, they need customer funds, because they don't have enough funds of their own in order to go around like that. And Silicon Valley Bank, by the way, had the privilege of having customers, the biggest tech companies, which means that the customer funds that they had at their disposal were, you know, they were not 10 or 20,000 bank accounts, right? The majority of the bank accounts there were from 250,000 and above. The number 250,000 I'm using is not a coincidence, by the way, because it will reappear in the story. The problem with Silicon Valley Bank is twofold. First and foremost, now that they collapsed and certain things came out, what Silicon Valley Bank did is that they lobbied in the United States in order to benefit from relaxed banking regulations. Silicon Valley Bank was part of a lobbying group that convinced American regulators to exempt so-called medium or small banks from certain banking regulations. These regulations were put in place after the 2008 crisis, and it was, so to speak, a protective measure to avoid having the same meltdown. In essence, what Silicon Valley lobbied to do is that they wanted to be allowed to make riskier investments with customer funds. That's in essence what they wanted to do. Now, why risky? Well, Silicon Valley Bank played a huge bet. They bought government bonds that they have a very late maturity date. Maturity date means that the day that the money is going to be paid back to you is 10 years down the road. That is a long maturity term, right?
And now, what's the reason why they did that? Why did they buy these?
Yes, well, government bonds are a very good investment when somebody does it on an environment of low interest rates, right? Because government bonds in certain environment, they give you a good yield, so to speak, for your investment.
So they hope to buy these bonds and in some time get profit back from them.
And get profit back from them, indeed. And they were believing that they will get profit from that because they made the bet that interest rates will remain at the record low levels of the past decade, right? So if that were to be true, yes, this bet would pay off. The problem is that this bet did not pay off. And by the way, it was a stupid bet to play all along because, so I'm not an expert on economics, but one thing I know for sure, that interest rates will never remain at the same low level. It is impossible. Because simply put, governments have to exercise monetary policy. And they have to exercise monetary policy because economy enters phases of recession and development. It is like, it is something like a force of nature that this is going to happen. It is, indisputable. So in a way, the Silicon Valley Bank and other banks that made similar investments were in fact begging or trying to threaten the federal banks to keep interest rates low for their bets to pay off. That's as simple as that. And you might ask me, of course, why do now central banks raise interest rates? Well, I think it's barely a surprise. We have to be reminded that our world went through a very horrible pandemic, a pandemic that put the entire economic output of the entire world at halt for almost 3 years, right? Which means, by the way, that governments need to take action, and the action that the governments took is that they printed more money in order to, subsidize economic activities for the period that the economy was not functioning. And then, of course,
Indeed.
Right after we came outside of the COVID pandemic, we have the war in Ukraine, which means that we have another shock in the economy. That means, and now this combined effect leads to high inflation. Why? Because there is excessive money in the market, right? And production did not catch up. That means that consumers have money to spend, but there are not enough goods there to satisfy their needs. And when that happens, the prices go up. And in conjunction with the war in Ukraine, the prices will keep going up because now a very important commodity, which is energy, is going higher because of the war. And what should the central bank do when prices go up and there is inflation? They will have to, put interest rates higher in order to slow down the economy.
That's right. So and we'll talk about this in the next CDLT Thursday in 3 or 4 weeks. We're going to touch on that, but also then why Bitcoin. We'll have another academic join us. But coming back to this, so ignoring the central banks and the external factors that's going on, what happened here was customer deposits were in a bank. The bank was undertaking typical activity, but one of their investments was, let's buy government bonds in hope that at some point in time, I don't know if this is the year, but at some point in time, we're going to get back a lot of profit. And these government bonds, due to all types of external factors, but from the bank point of view, they don't really care. They have these investments, right? This profit was not coming back. Not only were they not going to get this profit back, they were going to make a huge loss. And this is with the customers' funds. So then what happens? Then customers want to get their funds back, or they realize that there's not enough funds in the bank and they start panicking. They go for their funds. And this is when a bank run happens. But looking at this, Ioannis, so customers have their funds in the bank undertakes some activity with customer funds, things go wrong. That is exactly the same thing that we just discussed here. FTX had customer funds, did something they shouldn't have done, a bad investment, let's say, and the same thing happened. Now, my question is, over here, we have regulation. We have a lot of regulation. So what is the solution? Is there a solution?
No, I see the point. Joshua. Indeed, we have two cases where financial institutions are mismanaging customer funds. Right? That's undeniably a commonality. I think what is slightly different, of course, is that in the non-crypto financial system, banks play a pivotal role, right? And indeed, we have the regulation in place, indeed. But there are two major problems here, right? The first is that regulation on its own is not enough. To put certain rules in place is one thing. To be able to uphold the rules is a different thing. And usually where we fail spectacularly, not only in crypto, but also in banking, is the supervision of these institutions. Well, I have to admit, Joshua, that after the shock of 2008 and 2009, right, there has been a lot of work in the area that it would be unfair to underestimate.
That's right.
I'm not saying that we have solved everything and everything is perfect, but you know, certain excesses of the system seem to have been put in context,
That's right.
so to speak. But at the end of the day, that is a huge discussion. What I understand from many economists is that banks come with inherent problems that not even regulation might be able to solve or effectively solve. In fact, I am aware of certain economists that they even say we better do away with the banks, which, by the way, it's interesting, right? Because it's what the crypto communities have been saying for quite some time now. It's funny because in a way it kind of proves that no matter what will happen with any of the individual assets that people hold at their portfolios right now, digital assets have made the point that there is a systematic problem with banks, that we really need to discuss what we are supposed to be doing with them. When you see even economists talking about an economy without banks, I think that is a major validation of what crypto communities have been saying all time along. I'm not saying that crypto is necessarily the best solution. That is to be debated on another CDLT Thursday session. And of course, we can debate a lot, but I know that one of the ideas that seem to be getting some traction within economist circles is the idea of a central bank digital currency, which by the way would mean that there are no financial intermediaries like banks, that peer-to-peer transactions now will be available. Of course, Joshua, I know at the end of the day, of course, we will have the user problem. If it is a central bank digital currency, it's going to be a central bank, though, that we will have to trust with doing the right choices, right? But that, right, I guess, is a whole other discussion that we would probably have the opportunity to do in another CDLT Thursdays session. But yeah, indeed, I think we kind of learn a lot from these incidents also. I think we learn a lot not only about the crypto space, but also about the wider financial system.
Indeed. And I'd also like to highlight here that often what we're doing in the crypto and the blockchain space is we're proposing another extreme, right? We're looking at one extreme over here where there are people, there's organizations, but ultimately it's people. And we trust that the people are making the right decisions to make sure that our system works. On the other hand, in the blockchain crypto space, we're often proposing, no, we don't trust the people. We're just going to have a computerized system, a decentralized computerized system, and that's important because people can't control it. So this decentralized computer system will control everything because we don't trust people. So that's the other extreme. And actually, this is what we'll talk about in one of the, or probably the next one, is whether Bitcoin could be, or something else, it doesn't necessarily need to be Bitcoin, but whether Bitcoin could replace this. And who knows, right? That's another extreme. Where the reality actually is probably somewhere in between. Probably we need people, probably, I would say it's always good to have technology that can provide transparency and guarantees, but can that technology providing trust and guarantees fix certain problems that are inherent in our problems? When we have a recession, can we pump money into an economy? Well, with our current systems, we can't. We need someone to make a decision. So yeah, we'll be looking at that in a future one. But coming back to the CBDCs, so the central bank digital currencies, there's two main design options that were being presented. One is retail and one is wholesale, where the CBDC only interacts with the banks and the banks are still more or less the interfaces. And the other one's retail, where the CBDC interacts directly with the users. But that then gives the CBDCs a lot of oversight of what is going on, and which is great. But could there be some downsides to that? We'll see. I mean, now we're seeing CBDCs popping up around the world in the news everywhere, but who knows what's coming.
But it's interesting, though, Joshua, that stable coins have made such a strong point that it forced legacy financial institutions to think about central bank digital currencies. The whole discussion is fueled exactly because certain stable coins, as we called them in the beginning of the session, have gained traction, which as I said, crypto assets have already made a point, which probably cannot be refuted anymore. The ideas, so to speak, are here to stay for sure.
That's right. And interestingly, we spoke about this a bit before. So our banking system was on the gold reserve before, where there was gold backing the currency, and now we're on a fractional reserve system. And interestingly, there was a bill, I mean, it's just been proposed in the States to go back to the gold reserve. Ioannis, was there anything we learned from the previous system?
Yeah, well, first and foremost, we live in interesting financial times, right? Look at how many alternative ideas, right? Which by the way, probably displays once more that there are structural issues that need to be resolved in the financial system in order to avoid major incidents. Now, when it comes to introducing the gold standard, that's funny, because I think it is a very polarized issue among economists. I know that there are certain, so to speak, political fractions, especially in the United States, that they demand we go back to the gold standard. But look, we need to take something into account, at least from what we can follow from history, right? There are certain caveats to that. One caveat is that if we try to go to the gold standard, which by the way will not only happen in the United States, if the United States ever does that, everybody will try to do that. We're going to have a world economy which is going to be competing in very, very antagonistic terms. Because at the end of the day, if you go to the gold standard, the value of your currency will depend on the level of gold that you can hoard as a country. And look, there are two ways, more or less, okay, let me say three ways to hoard gold. Your country must have, if you are lucky, gold reserves. So you can mine it from the ground and you can hoard it, right? I can tell you, Joshua, that there are certain countries that are privileged. Russia and the United States are amongst them because they have the largest, some of the largest gold reserves underground still left. And there are some African countries and China that are also involved in that. But as you can see, this is not really a sustainable solution for many reasons. First and foremost, because gold reserves are going to be depleted at some point. And secondly, because gold distribution is not equal amongst countries, countries might get tempted starting wars over gold reserves. And, you know, and also wars can also be started because if you don't have enough gold to mine from the ground, then you try to loot it from somewhere if you cannot take it from the ground. And that kind of looting can come both in the form of a trade war or in the form of a real war. And I don't know. Secondly, I think a very good example about the limitations of the gold standards is probably the financial crisis of 1929, because at this stage, the United States was operating a fully fledged gold standard at the time. And because the United States was trying to defend the gold standard peg, it was not able to take monetary policy measures that would allow the economy to come out of the recession. In fact, that made the recession even worse. This is why it is called depression and not recession. One of the first things that Franklin Roosevelt did was to go out of the gold standard. And by the way, it was not only the United States that did that, Great Britain did that and recovered. And I can tell you that even my own country, Greece, which is always susceptible to economic disaster, did the same. Greece was in the gold standard, and when Greece left it, it partially recovered because it was able to use monetary policy tools. One of them being printing more money. Again, I'm not saying that printing more money is an ultimate solution. It comes with its own problems. But at least it makes, there seems to be some consensus among economists, no matter the school that they're coming from, that monetary policy helps make the blow softer. You're going to have a recession, but it's going to be a recession that you can take, so to speak. An interesting fact is that in the 1929 crisis, exactly because the United States was unable to exercise monetary policy and they were trying to defend the gold standard peg, is that their economy entered the phase of deflation. Now we have introduced two economic terms. Inflation, I think we all know, it's when prices go up because there is excessive money. Deflation, though, is the worst nightmare of all economists. While all of them argue how to deal with inflation, they all agree that some inflation is good. Where they all agree also, though, is that deflation is bad. Like deflation is the death of the economy. And that's exactly what happened in the United States. If you look at the value of the US dollar between the 1920s and the 1930s, in the beginning of the 1920s, if you had $200 in your hands, it would be 168, if I'm not mistaken, in the early 1930s, which means that their economy entered a deflation phase, which explained uncontrollable unemployment and, of course, complete dissolution of economic activity.
Yeah, so I won't comment on that because my economics is not worthy for a public webinar. We'll come to a question or rather, Ioannis has his hand up, and we'll come to that. One thought that did come to my head when you're mentioning so wars being started because of gold, or even many people say that the US dollar is backed by the military when you ultimately dig into it. One potential thought experiment is if we, and a lot of people are talking now that the dollar might be become no longer the world currency. One interesting thought experiment: if Bitcoin had to become a reserve currency, then could we essentially get rid of this military backing of a currency? Because Bitcoin is just going to do whatever it does without fail, and there's no wars that one can try to raise the value of Bitcoin. I mean, no one controls it. It's equally decentralized. So I think that's just an interesting thought experiment. I'm not sure if you have any comments on that before I open the floor for
Ioannis. Army Bitcoin, right?
Pardon?
I think Bitcoin doesn't have an army and it is difficult to loot it, right?
Well,
that might prompt cyber wars. Different types of wars. Who knows?
And some might say that there is a military behind it, the Maxis. So I'm gonna open the floor to Ioannis. You are now on the floor, Ioannis. We have two Ioannises on the floor.
Just so I warned you, most popular name. Right?
You'll need to. Hi,
Yes.
Ioannis.
Hello. How are you? I'm
Not too bad.
following the discussion. It's very interesting. And okay, congratulations for this good information that you're sharing with us. I don't know. I don't have to mention something specifically. Just that we are all of us looking to the space of cryptos, how it's going, and we hope that okay, it will make a good improvement in the future and make the things much more clear.
Excellent.
I agree on this, and I think that this is inevitable. That will happen. No,
Indeed.
I don't know if it happens soon, but in a day it will happen.
But Ioannis, you would not take a bet that Bitcoin would go up to 1 million within 90 days, right?
No, I do not bet at all, and I'm afraid to bet in Bitcoin, in any cryptocurrency that is high volatile, or at least I am scared to bet a lot of money. If I had a lot of money, I wouldn't invest. Okay, but I follow with closely. I have also some good friends of mine that are more active and more knowledgeable in this area. I know that you know Nikos Kostopoulos. We are working together.
Excellent.
And okay, we are dealing with many things in this part, and we are trying also inside our work to connect the DLTs and the blockchain with enterprise, which is not very successful yet, but also this will happen one day, and it will contribute to the best work in the enterprise world as well. as it does now in the finance. So that's all from my part.
Excellent. Thanks, Ioannis. Thanks for the positive words of encouragement. And I think right now what we're seeing is a change of perception from the extremes where people are coming into this space. Like some people with the extreme that this is the best technology ever, it's going to change the world, everyone should know about blockchain and crypto. And then the other extreme where people are saying this is the worst technology, this is going to destroy the world. And I think we need to take a approach where we're just a balanced approach, taking in all of the facts and applying it where necessary. But thanks a lot for that.
And by the way, I think one of the key messages of the crypto disasters that we have visited is that, in essence, they are no different than disasters that happen already within the financial system. There is nothing inherently wrong with the technology. It's not really the technology because, you know, at the height of the FTX collapse, I remember many people saying that, yeah, stop this scam-making technology. But it's not really the technology. Of course, the technology allowed the financial genie to come out of the bottle, but is that not necessarily a bad thing? It more or less gives us the opportunity to reflect on issues that are important to be discussed.
Indeed. In fact, on that point, one of the major criticisms that we tend to hear in the space is that this is mostly the crypto space, the blockchain stuff. This is mostly technology and let's call it money that is used for illegal activity. And if you look at the reports, what they say, it actually shows a completely different picture where there was a report by Chain Analysis in 2020, the 2021 report. Okay, it says in 2019, I don't know exactly, but over here it states that in 2020, the amount of criminal activity on cryptocurrency fell to 0.3% of the usage. And if we look at the criminal activity in our traditional world, it's 2 to 5%. So it's much less, being used for much less than the traditional world. Now, there is some controversy that Chain Analysis is a crypto-related company, so their report might be biased. But my answer to that is very simple. Just can we not create a report with a factual answer from someone else? And also on that point, it's not in Chain Analysis' interest to say there's no criminal activity. And the reason is Chain Analysis is a company that gets paid by all of our institutions around the world to help them find criminal activity. So if there was zero criminal activity, they would make less money. But I think that's another interesting point to note. Ioannis, I'm not sure if you have any closing thoughts or if any questions from the audience.
Yeah, very, very generally, I think that 2022 was, I think, a coming of age year for the industry. In a way, the enactment of the markets and crypto assets regulation that will be coming very soon is probably coming at a very critical juncture, and is probably, as we have seen from this incident, something that is probably necessary. The age of Far West is slowly coming to an end, which probably will allow the technology in the industry to mature even further. I have no further closing comments, Joshua, only one, and that is that for those in the audience that want to keep discussing on these matters and for what worth want to see us in person, they must be informed that we have a summer school. Like we did last year, I have just sent the link on the information about the summer school in the chat. If anybody is interested, please have a look at it, because issues like the one that we discussed today and issues like those that we're going to be discussing on every CDLT Thursdays event are going to be also analyzed during the summer school, with the extra benefit of having the opportunity to go around Malta for 10 days between July 17 and July 27. We have planned all kinds of activities that would allow people to either approach or deepen their exposure to the industry. So everybody would be very much welcome.
Indeed. And there's a question from Monica. So when there is a collapse like that of Terra Luna, can there be a recovery? So when was the collapse of Terra Luna again, Ioannis?
It was back in May 2022. I think prices have picked up since then. Like if we go back in the day, Joshua, will see you see the huge slump that crypto takes around the time of Terra Luna, right?
Yep.
And then there is another huge slump around November when FTX goes down. And then prices have started to pick up a bit. But I think
Indeed.
Monica's question is critical because while Bitcoin's price might go up and down, the real tragedy when we have such collapses is what happens with the customers, the people that were trusting their money in these institutions, because many of them might be irreparably economically damaged. And that is another dimension that is important. In the Silicon Valley Bank case, we explained that they took a nasty bet, but at the end of the day, the Federal Reserve bailed them out. But the scores of people that lose their money on FTX or Terra Luna, they don't have that protection. And that is also something that we must take into account. Of course, recovery will happen, but it comes with costs, this recovery. And usually the costs are the small investors or retail customers, as we say. And that is the duty, I think, Joshua, both of computer scientists and legal or economic scientists to find a way to immune or at least protect these small customers from these disasters. Because at the end of the day, look, the Sam Bankman-Frieds and these people, one way or another, they will find a way to recover. One of the people in the managing board of Silicon Valley banks was one of the people involved in the 2008 economic crash, which means that it is always light, or they can always go to the green side themselves. But
and I think they took a bonus, right? Just before the crash, they took a bonus as well.
Indeed, of course.
Yeah.
And of course, right before the crash, they started selling stock as well.
Indeed. And as well, we're starting to see the ramifications of the crash. So Terra Luna led to FTX. Now we're starting to see a lot of companies go bankrupt because FTX promised money to some investment firms promised money to some startups. And just now, day after day, I'm hearing about some friends who tell me the company they're working with went bankrupt because of this snowball effect. So I think we haven't seen the full effect of it. I think the wider recession that we're going through is also going to have an impact. But hopefully, this technology that ultimately brings transparency, accountability, verifiability, hopefully we find the right balance, not only for the crypto space, but to use in the wider sectors that we operate in. Hopefully for a fairer economy ultimately at the end of it.
And of course, it's always worth reflecting on such incidents. I really believe that they teach us a lot. And by the way, it is interesting that Doug Wong got arrested because there is a hope now that we might learn more about the way he conducted his business, because that will allow us to be better prepared for future incidents. You know, look at how many things we learn, by the way, just right from the Terra Luna. For example, algorithm stable coins are anything but stable unless they are backed by something real, so to speak, and not an algorithm. Or 20% yields is probably a red flag. Or from FTX, for example, lack of transparency and all kinds of gambling with customer funds. These are all lessons to be learned, and we are learning. Again, I refer again to the markets and crypto assets regulation. If FTX were to operate under the regulation, some of the things would not happen because of the obligations installed there. They would have to get a license in Europe. Some of the management board must have been in Europe. They should have had a clear customer fund policy. You know, many things could have been averted.
That's right. And the computer scientist hears you saying that wants to counteract with this, but we can provide guarantees in code. And I think what we'll do is in future, we'll have a code versus law CDLT Thursday segment. But I think for now, we thank everyone for joining us, and we'll send out an update of our next CDLT Thursday. Thanks, everyone. Wishing you a pleasant long weekend if you have one.